Let's start by looking at a basic cash flow valuation template. We're trying to project future cash flows using the free cash flows from the current year. Assuming that we're standing at year 0 and the current free cash flow is $1,000. We want to analyze the present value of a project that has a lifespan of 5 years. The question is, what is this project worth? And if a company only has this one project in their pipeline, and the company has 1,000 shares outstanding, then what is the intrinsic value of the company stock? To answer these questions, we have to first project out the company's free cash flow into the future, and then discount them back one by one to find out what is the present value for all the future cash flows. Be aware that the investment that you made for this project, such as buildings, equipment, and machineries, will continue to generate incremental cash flows beyond the termination point at end of year 5. And therefore, we have to capture all the future cash flow beyond the termination point in a term called terminal value, which is stated at end of year 5. By calculating all the present value of future cash flows, including the terminal value, and sum them up, give us the enterprise value of this project. And the enterprise value will tell us how much this project is worth. And since the company only has this one project in their pipeline, then the intrinsic value of the company's stock can be calculated using the estimated equity value divided by the number of shares outstanding. And therefore, in this example, we computed the fair price of the company's stock as $12.93. And this is the basic idea behind how to use the DCF model. Now that you're familiar with the basic cash flow valuation template, let's look at an example. Based on this template, in order to forecast future cash flows, you have to know what is the current free cash flow at year 0. If the current free cash flow is not known, then how do you estimate it? This example in the following shows you a quick way to calculate historical free cash flows using the statement of cash flows. For ABC Corporation, you downloaded the statement of cash flows from 2008 to 2012. The statement of cash flows breaks down the sources of cash flows into 3 categories: operating activities, investment activities, and financing activities. In order to estimate unlevered free cash flow, we have to first locate the values for all the input variables that go into calculating unlevered free cash flow. Let's quickly review what input variables are. Specifically, we need net income, depreciation amortization, changes in net working capital, changes in capital expenditure, and after-tax interest on debt. Now let's try to identify these variables on the cash flow statement. In the first category, you have all the cash flows from operating activities. There you start with net earnings, which is equivalent to net income, followed by net cash adjustments, including depreciation and amortization, and changes in operating assets and liabilities. This is equivalent to changes in net working capital. Be aware that the numbers on the cash flow statements are on the yearly basis. It summarizes all the cash flows for a given fiscal year. That means all the depreciation, amortization, and changes in net working capital are accrued in a year, which is what we need for calculating unlevered free cash flow. Moving on to investment activities. Under this category, we have short-term investment and long-term investment, which is equivalent to PP&E. There you have the purchase of PP&E and proceeds from dispositions of PP&E. We'll definitely need all the PP&E information. The third category is financing activities. There you have all the cash flows related to stock, debt, and dividend. Since unlevered free cash flow is the operation free cash flow, we don't need any cash flows from the financing activities. Under the supplemental disclosure of cash flow information, we have income taxes and the net interest on debt. And from those two variables, we can estimate what is the income tax rate, which is equivalent to using the total income taxes divided by income taxes plus net earnings. And once we estimated what is the tax rate, then we can use the tax rate on net interest to compute what is the amount of after-tax interest on debt, which is the last variable we need for calculating unlevered free cash flow. Now that we have located all the input variables for unlevered free cash flow, let's make adjustments to the cash flow statement to retain only the relevant information so we could quickly compute unlevered free cash flows. In the next tab, I copied over the statement of cash flow for ABC Corp and then eliminated all the irrelevant information on the statement of cash flow. Specifically, I retained all the information under operating activities because all of them are relevant, and then deleted short-term investments from investing activities, and then got rid of all the cash flows under financing activities. The next step, I will compute what is net cash provided by each category, and then sum them up. By summing up all the free cash flows under each categories, I computed what is the free cash flow before interest adjustment. The word unlevered in unlevered free cash flow implies that it's a free cash flow before the dissemination of debt payments. So you do need to include the after-tax interest on debt as part of unlevered free cash flows. And therefore, we'll add back after-tax net interest to the total free cash flow estimated from the cash flow statement. And then we'll have unlevered free cash flow, like this line here, befitting the definition for unlevered free cash flow. Now we need to use the most recent unlevered free cash flow. In this case, it is unlevered free cash flow of the fiscal year 2012 to make projections for the future unlevered free cash flows. The next tab is similar to the basic cash flow valuation template, where we start with free cash flow of the most recent year. In order to project future unlevered free cash flows, we need to make certain assumptions on how the future free cash flows will grow. The assumptions we made is that within the lifespan of this project, the free cash flow will grow at a steady rate of 8%. And after the termination of this project at the end of year 5, the investment we made for this project, such as plants and machineries, will continue to churn out cash flows for the company. We assume that the free cash flows beyond the termination point will grow steadily at a smaller rate of 5%, as captured in this long-term free cash flow growth rate. In the end, we assume that WACC, which is the discount rate for all future free cash flows, is known, equal to 10.7%. All these assumptions are given to you right now, but in the later part of the course, you will learn how to make these assumptions yourself. Once we have all the assumptions, we can start to project out all the future free cash flows, as you can see here. All the future cash flows beyond the termination point is captured in the terminal value here. We'll explain how to compute terminal value later in the course as well. Next, you will sum up the total free cash flows from each year of the project's life in order to compute what is the net benefit of this project by using a NPV formula. The result gives you the enterprise value of this company. By adding back initial cash and subtract out the total debt of this company, you can estimate what is the net equity value of the company. Dividing equity value by the number of shares outstanding, you have the estimated share price, or the fair price of the company stock. In this example, the estimated share price is $11.76. You can subsequently look up what is the current market price of the company and compare it with the fair value of the stock. If the market price is higher than the fair value of the stock, then the stock is overvalued by the market. Because if the stock market is efficient, then over time, the stock price should revert back to its intrinsic value. So you might consider issuing a sell rating for this stock. If, on the other hand, the stock is undervalued by the market, that is, the current trading price is lower than the fair price, then you could consider issuing a buy rating to the stock. You could also create a two-dimensional data table to explore how robust your assumptions are for WACC and long-term growth rate based on your base case. If you build a two-dimensional data table by changing the values for WACC and long-term growth rate, then you could see that your estimated share price will change based on different values for WACC and long-term growth rate. You can see here that your estimated share price is very sensitive to the changes in assumptions. We'll talk more about how to adequately use the data table for DCF analysis later. The last tab, colored in orange in the class file, is the valuation template for Merck. This is the second case study that you can use to play around in order to learn the basic structure of a DCF model. So I'll leave this example for you to explore.